Hey guys, you're looking at Uncle Dwayne's watch list, and today we're going to be talking about the company which is known as the Hershey Company. We're going to go over the fundamentals of them, how well this company is doing, because when you're buying stocks, you're really just buying shares of a company. So we're going to talk about the fundamentals of this company. And we're going to talk about the technicals, how well the stock is actually doing. So if you look at the chart that I actually have up right now with these green candles and the red candles, green candles represent a period of time when the stock is moving up, and red represents a period when it's moving down. And you'll notice for the Hershey Company, it was moving up quite a bit. Now, these candlestick charts, you can break them down into different time periods. And I have this one broken down into years, 12 months. So every candle represents a year. And you'll notice that Hershey has been moving up quite a bit for years. But this year, it's actually moving down, and it's moving down quite a bit. All of the gains that it made, all of the gains that it made last year, it's already lost this year. But that's not unusual. We have a lot of companies that are struggling at this time. I'm not sure what the cause is, what's going on with the economy, but a lot of fundamentally sound companies are going down right now. They're struggling right now. And that could be a cause for concern for many people, but it can also be an opportunity. It could be an opportunity to buy fundamentally sound stocks that are going to go up in value and to buy them now when they're on sale. So, this is our annual chart, our yearly chart of Hershey. Like I said, every candle here represents a year. Now, I'm going to change the settings so that we can look at a weekly chart. Now, every candle is representing a week. And noticing it's been going down for weeks, weeks at a time. But when you find a good, fundamentally sound stock at a good price, that's a situation where you could wait for it to keep moving down. And then when it finally hits that bottom and it starts to turn up, you jump right in and buy. I like to see it moving up for about a couple of weeks. For about 2 weeks, I like to see it moving up and I'll jump in. Although sometimes I get a little anxious. If I see it's a great deal, I'll jump in after a week. So now these are the technicals on the Hershey Company. I like to use the technicals to figure out when to buy. But now we're going to go to the fundamentals. And the fundamentals is where you figure out what to buy. Fundamentals to know what to buy, technicals to know when to buy it. Now that we've talked a little bit about the technicals of the company, looking at its movement over the last few years and its movement over the most recent weeks, now we want to talk about the fundamentals. When we were looking at the candlestick chart, we were talking about the stocks, the stock price, how it's moving. Now, what underlies that stock price is an actual company that you're buying a share of. And now we want to look at the fundamentals of this company to see if it's worth buying. Or we should say, if we feel it is worth buying, which we definitely feel it is because I'm doing a video on it. Why? So let's look at it now. Hershey Company. The ticker symbol for Hershey Company is HSY. Now, I must say that all of the data that I'm using to make these estimates on the Hershey Company are from Macro Trends and Yahoo Finance. So if you want to know where I'm getting my figures from, they're from Macro Trends and Yahoo Finance and the calculations based on those figures. So the first thing we want to start with is the earnings per share. Earnings per share is basically earnings or profit that a company brings in every year. How much that is, but it's divided by the number of shares that that company is making available to be purchased. So, numbers can be skewed a little bit with this because if a company is buying back shares of their own stock, that will boost the earnings per share up a little bit. But we're going to not just look at the earnings per share, we're going to look at the actual full numbers as well as we go down. But we want to see earnings per share in positive numbers. Now, what I do is I analyze stocks that are at the 52-week low to see when they're fundamentally sound. Because I don't want to just buy a stock anytime. It could be the greatest stock in the world, but it could be at the highest price of the year. And I buy it and I have to sit there and wait while it goes down throughout the whole year until it starts to go back up again. I don't want to buy that. I want to buy it when it's at its lowest price in the year. So, here we are, Hershey Company. I found it at the 52-week low. And we're going to look at the earnings per share for the last 5 years. We want to we want to understand where this stock has been over the last 5 years so that we know we're buying something that's not just doing great one year, but it has staying power. It's been sticking around. It's been moving through the years and doing okay. So if we look at the earnings per share, there was $5.58 in 2018, $5.46 in 2019. It dropped, but just a little. $6.11 in 2020. So it's continuing to move up. But what's also significant about that is that 2020 was when everybody was locked in the house because of the COVID lockdowns. And yet Hershey managed to make more money that year. $7.11 in 2021 and $7.96 in 2022. So we look at the earnings per share, it's looking good. Next, we have the low price of the stocks every year and the high price of the stocks every year. In 2018, Hershey went from $79.69 a share to $100.83 a share. And then in 2019, from 94 to 149, 2020 from 104 to 150, 2021 137 to 187, and then 2022 from 187 to 238. And now it dropped back down, but it's at 190. It's a little above where it was at its lowest point in 2022. So notice that the low price is increasing every year. 79 to 94 to 104 to 137 to 187. Here you could have bought this stock for $79 a share in 2018. And now in 2022, it would have cost $187 a share. If it continues at this course, then what is it going to cost at its low price 5 years from now? What is it going to cost at its high price 5 years from now? From 79 to 238. And notice, not only is the low price increasing every year, so is the high price. $100, $149, $150, $187, $238. Okay. Now, like I said, the low price of a stock changes every year. It could be going down if it's a bad stock. It could be going up if it's a good stock. But you can't guess by the price where it's going to go and stop and turn back around. But there is something that you can look at, and that is called the PE ratio. And notice that for each of these years, there's a high PE ratio and a low PE ratio. So the low PE ratios for Hershey since 2018 has been 14, 17, 17, 19, and 2022 it was 23. And what's the PE ratio now? The PE ratio right now is 21 or 21.97. Now, I'm sort of cutting these off. I didn't read the whole thing. 14.28, 17.36. I'm sort of just rounding it off. But right now, the PE ratio is 21.97. And if we know or we look at these PE ratios, we could calculate them with the earnings per share to see what this company could come down to. So, for example, right now, at a PE ratio of 21.97 and an earnings per share of 8.69, the stock is $190.94. But what would happen if the stock were to fall to 2019, well, let's say 2020's low PE ratio, which was 17.03. If we say 17.03 times 8.69, then we see that this stock if the PE were to fall to 17.03, of which it's been to 17 twice, the stock would fall to $147.99. However, we have to take into consideration that we don't have to tolerate a stock falling and we stay into it. We may buy the stock and we notice it's falling for a week. We sell, we jump out of it. And if we want to get back into it again, jump in when it starts to move back up. However, there are always other opportunities in the market. Usually, if I buy a stock and it starts dropping and I jump out, I'll jump into something else that's just as promising or more promising. So, we're going to look at two ways of estimating where this stock can go. First, I noticed that in 2018, from low to high, the PE rose about 4. In 2019, it rose 10. In 2020, it rose 7. In 2021, it rose 7. And in 2022, it rose 6. So let's say 6. Let's add 6 to it. So I'm going to look at the current PE, 21.97. Let's say it moves up from here and doesn't go back down. 21.97 plus 6 is 27.97 times the earnings per share, which is 8.69. That gives me, something's wrong here, 27.97 times 8.69. That brings me up to 243.05. So based on what I see in the PE ratios alone, I could speculate that this stock can go up to $243.05 a share from the current $190.94 within the next 12 months. But there's another way I can do this. If I switch over to Yahoo Finance, under summary, I could scroll down to 1-year target and it will tell me the Yahoo analyst prediction of where this stock will go a year from now or within 12 months. And that's $243.05. So we can look at the method of determining where the price can go by calculating the PE with the earnings per share, or we can use Yahoo's analyst. I'm not sure what they factor in when they predict where they feel these stocks are going to go, but either way would be acceptable. So now that we've looked at the price for the stock, let's look at the numbers for the company. How well is the company doing? So how is Hershey doing? Well, one, if we look at their overall sales or revenue for each year, in 2018 they made 7.7 billion, 2019 7.9 billion, 2020 8.1 billion, 2021 8.9 billion, and 2022 10.4 billion. 10 billion, I'm sorry, 10 billion 400 million. So every year their total sales or revenue increased. Then we come down to the net income. Okay, they made 7.7 billion. 7.7 billion. But when they paid all of their expenses for that year, how much did they have left in profit? 1.1 billion. 2019 they made 7.9 billion. But when they paid all the expenses, how much did they have left in profit? 1.1 billion. 2020 they had 1.2 billion. 2021 they had 1.4 billion, and 2022 they had 1.6 billion. But there's another factor we should look at as well. We know how much they made for the year, and we know how much they kept in profit at the end of the year. But after factoring those things in, what was their profit margin? In other words, of all the money that they made, what percentage did they keep after paying all their expenses? And it was 15.11% in 2018, 14.40% in 2019, 15.69% in 2020, 16.47% in 2021, and 15.79% in 2022. And I could tell you, for a company, these are some pretty decent profit margins. Depending on what the company does, their profit margins are better. You may find a technical company and they may have profit margins of like 30%. A bank may be around 20 some percent. There are a lot of companies who have profit margins of 1%, 2%, 5%. I analyze a lot of companies, and it's not unusual to find companies doing like 5%, 2%. So 15, or I would say from 14 to 16% is decent. Now let's go down and we're going to look at return on equity. And notice the return on equity, what's the return on what's owned, the shareholders' equity. Return on equity is very decent at 83%. The only problem is if you look at the line underneath, which is debt to equity, that debt to equity is a little high, and a debt to equity that's like over 200%, it can skew the return on equity a little, so that the return on equity may be showing at a number that it's really not at. And that may be the reason why we see the return on equity number decreasing every year, because we see the debt to equity number decreasing every year. We see the debt to equity at 447% in 2018, and it decreases every year until in 2022 we see it's at 231%. And we may end up looking at 2023's figures when they're complete and see that the debt to equity has actually gone below the 200%, more to the norm. But in any event, return on equity 83%, 65%, 57%, 53%, 49%. And if we look at 49%, even though it decreased from 83%, 49% is a pretty spectacular number for return on equity. So let's see if the debt to equity drops underneath 200 in 2023, and then see what the return on equity is. But I like the fact that they're decreasing debt. And speaking of debt, let's look at their balance sheet. Balance sheet is broken down into four figures. One is the current assets, assets that are owned under a year, and the current liabilities, those are debts. Assets, what they own, debts, what they owe. Those are debts under a year. And then total assets, everything they own, short and long term, and total liabilities, everything that they owe. And you prefer to see higher assets than liabilities. Now, this company in 2018, their current assets was actually lower than their current liabilities. In 2019 and 20, it was the reverse. The current assets was higher than the current liabilities. But in 2021 and 22, the current assets were lower than the current liabilities again. Now let's look at total assets and liabilities. Every year, the current assets were more than the current liabilities. So this would be what I would consider not a great balance sheet, not even a good balance sheet, but an okay balance sheet. I can live with this. Now, we're going to move towards the bottom of this, and we're looking at dividends paid. Notice the company does pay a dividend. They're paying out money every year in a dividend. We're going to see what that dividend is as we get to the bottom of the spreadsheet. Changing capital stock. In other words, they're buying back more shares of their own stock every year. 184 million this year, 286 million this year, 164 this year, 408 million this year, and 354 million this year. I like to see companies buying back shares of their own stock. And actually, when they do that, it tends to make the stock price go up. Then we have information about loans that they took out or paid back. But we really accounted for that in the balance sheet, so we don't have to go through that. Next thing we look at, if we work out what their cash flow from operating activities were, and the net change in property, plant, and equipment, things they had to buy, from that figure we get the free cash flow. Now, the income statement showed us how much money they made each year, the profit that they had after paying all expenses. But there's things that can be done with the income statement to sort of skew numbers a little bit, some accounting stuff. But what you can't play with is free cash flow. That's the money that they had at the end of the year. That's the actual cash. And if we look at the free cash flow, notice I put down here so we could see the difference. We have their net income, that's the money that they made on the income statement, the profit they had left over after all expenses were paid. But free cash flow is the actual money they had. And notice the free cash flow in, let's see, 4 out of these 5 years, the free cash flow was more than the net income. And why is that? Because they may have extra money from one year that they don't spend, so that money carries over to the next year. So where we see their free cash flow exceeded their net income in every year but 2020. But what I did above here is we know that this company pays a dividend. When they have that free cash flow, they take some of that money from the free cash flow and use it to pay dividends to their investors. We want to make sure that the dividend that they're paying you is not from money that they borrowed, but it's from money that they have. And so here we have a line, free cash flow after dividends. So now they've had the free cash flow. I've deducted the amount of the dividends that they paid out. And notice they still have money left over each year. 758,000,000, 835,000,000, 617,000,000, 901,000,000, and 1,033,000,000. Then we come down to the last information which we have at the bottom, PB ratio, because their book value is how much money the stocks would be worth if they were to close overnight, which I doubt. But I don't want to go into it, but this is really a faulty number in certain ways anyway. And if I get some comments asking about it, I'll explain why I say that. What I find more important is that they're buying back more shares of their own stock for the last 5 years. I'm not necessarily concerned about the book value if it's not a negative number. So shares by insiders, shares held by people who work in or are part of the company, 0.19%. That sounds like a small number, but that's 0.19% of 149.85 million shares. So it's not a small number. Shares owned by institutions, large banks and institutions, 82.16%. And what's their dividend yield? Well, the last quarterly dividend they paid, believe it was a quarterly dividend, was $1.19 a share. And their dividend yield is 2.54%. That means of every share of stock that you buy, they're paying you back 2.54% a year in dividends. Now, this company, Michelle Gross Buck, is the chairman, president, and CEO of Hershey Company, and she was appointed CEO in March of 2017. Why is that important to know? Because if we looked at the company and we've seen that it's done well for the last 5 years, and we see that the same woman has been CEO for the last 5 years, and we're not hearing anything about her leaving anytime soon, then we have confidence in the way the company is being run. And Hershey Company is in the confectionery industry. Mars is at the top of that industry, but Hershey is one of the largest companies on the list in that industry. Okay, guys, please like, comment, subscribe to this video, and I will be dropping a bunch of other videos on timely stocks that you can buy, stocks that are not only fundamentally sound, but they are at or near what we would consider the 52-week low. Okay? And just so you know, today's date is October 23rd, because I don't want you just running out and buying a stock because it's a great company. I want you buying the stock when it's a great company at a great price.